Most entrepreneurs think forming an LLC will automatically save them thousands in taxes every year. But here's what business formation companies don't tell you. An LLC by itself doesn't change your tax situation at all. Here's what we're covering today. The 5 biggest LLC mistakes that are costing people thousands of dollars. But more importantly, I'm going to show you when you actually need an LLC, when you don't, and how to avoid the expensive traps that catch most new business owners. I'm Bob Wolfe, and I've spent nearly a decade as a certified financial planner and IRS enrolled agent. An important disclaimer here, everything I'm sharing today is strictly educational and should not be interpreted as specific legal, tax, or investment advice for your situation. Mistake number 1, setting up an LLC before you actually need one. For most small side hustles or businesses just starting out, you're actually creating more headaches than you're solving. Let me paint you a picture. Sarah starts an Etsy shop selling handmade jewelry. She's making about $500 in monthly revenue, maybe $200 in actual profit after materials, so $2,400 a year of profit. But she spends about $1,000 setting up the LLC, plus she now has $800 in annual state fees that she didn't know about. Now she's spending about as much on the business administration as she is in taking profit. First thing that I think about is number 1, are you making consistent profit of $2,000 to $3,000 monthly? Not revenue, profit. Number 2, does your business have genuine liability concerns beyond normal business risks? Number 3, do you have significant personal assets that you need protection from? Number 4, are you prepared for the additional compliance requirements and costs, and do you know about them? Each of these are very state specific, as any entity is formed at the state level. If you answered no to most of these, here's the surprising truth. You're likely better off starting as a sole proprietorship and upgrading when your business actually grows. Which brings us to mistake number 2, choosing the wrong structure for your money. Did you know that the type of income your business generates should heavily determine what kind of entity you form? Now let's break down the 3 main types of business income and how each one has optimal structures. The first type of income is ordinary income. We're talking consulting services, product sales, actual income. This is subject to self-employment tax plus regular income taxes on top of it. With passive income as the second piece, we're talking rental real estate, royalties. This is actually not subject to self-employment tax. A standard LLC is often perfectly fine to shield from liability concerns. And the last level of income is portfolio income. We're talking about investments, dividends, capital gains. This is 3 completely different rules and optimal structures for each of them. The kicker here is that understanding your income type isn't just about compliance, it's about optimizing your tax situation. The right structure based on your specific income type can save you thousands of dollars annually that you don't have to legally pay. Mistake number 3, the EIN disaster. Now, you get your LLC, you get your EIN number, which is your Social Security equivalent of your business, and then you completely fail to use it properly. I've discovered this pattern while reviewing several business structures. People set up their LLCs and then they run everything through their personal account because it's easier to track. What they don't know is that they're committing something that is called piercing the corporate veil, which is legal jargon that means they've invalidated their liability protection. So the reality here is that if you're not using your EIN properly for all transactions, your LLC protection may very well end up being worthless. Courts can treat your business as if it doesn't exist separately from you personally. Now let's talk about the EIN protocol. This is crucial. First, open a separate business account using your EIN immediately. Second, run all of your business income through that account. Third, pay all of your business expenses from that account only. When in doubt, put any sort of business expenses on your personal card. You will always be able to work with your accountant, but this allows you to protect yourself from a liability side. And get a business credit card in your company's name. Lastly, never mix personal and business transactions if you can avoid it. Proper EIN usage, employer identification number usage, isn't just about legal protection. It's about building business credit. during economic downturns or emergencies. Businesses with established credit histories and proper documentation were far more likely to qualify for assistance programs. If you have an LLC right now, stop what you're doing and check. Are you using your employer identification number for everything business related? If not, you might have expensive protection that doesn't actually protect you. Mistake number 4, missing forms that cost thousands. There are at least 5 different forms you might need to file depending on your LLC structure, and most people don't necessarily know which ones apply to them and when they're facing penalties. I recently worked with somebody who was a single member LLC, meaning they owned it entirely, for his consulting business and received an IRS notice about unfiled forms and potential penalties. He thought filing his personal tax return was enough, but he was wrong. Let's talk about those hidden compliance requirements now. Number 1, Form SS4, your EIN application. Next up, we have Schedule C. This is a tax return schedule that's added on top of your personal filing for single member LLCs. You own it entirely to be reporting your income on your personal tax return or your 1040. Next up is we have Form 1065. This is for multi-member LLCs. We have a partnership with another individual or several individuals. This will be an entirely separate tax return that then thereafter we will have another form that is something called the Form K1. A Form K1 is where each partner's share of income and deductions in the partnership is going to be reported to them the same way like we have a W-2 or 1099 from any income that we have to them on their tax return that they need to make sure that they're given to their accountant. Next up, we have W-9 forms. These are for contractors that you pay over a certain threshold to on any given year. This threshold does tend to change and is actually increasing as we speak. Next is we have annual state reports. Requirements vary widely by state. These are state requirements that we make sure that we are in good standing with the state, since ultimately we file these businesses with the state, not the Fed. Though we do report to the Fed on our income and our expenses. What's interesting about these compliance requirements is that we're not just trying to be avoiding the penalties. Proper compliance creates a foundation that allows your business to grow on top of, and many businesses can't secure funding or expand because they've neglected these fundamental requirements, getting into issues with banks when they're getting underwritten for loans when they're trying to expand. So the compliance success system. Number 1, create a compliance calendar with all of the filing deadlines. Number 2, budget for annual state fees and sneaky franchise taxes. This is something that is sneaky in the states of New York, California, and Tennessee. They do come up on you, and you need to really be careful about what types of additional taxes you are adding into. Number 3, set aside time quarterly to review those requirements. This can be helped by making sure that we are doing step number 4, working with a tax professional who specializes in small businesses. Mistake number 5, the tax savings myth. Forming an LLC does not automatically save you money on taxes. In fact, for most people, it just changes nothing about their tax situation. A standard LLC is a pass-through entity. The business income still passes through to your personal tax return exactly like a sole proprietorship income would have. To actually potentially save on taxes with an LLC, you need to, number 1, elect an S corporation as a taxation and meet specific requirements. Number 2, set up proper salary and distribution strategies. Number 3, have enough profit to make the additional complexity worthwhile. And number 4, maintain strict compliance with the S corporation requirements. Let's talk about how I would be going about looking at these potential options. Number 1, if you're under $50,000 of profit and do not have any sort of partner, a standard LLC or sole proprietorship will get you through until you end up getting more money. Once you start to reach the $50,000 to $100,000 of profit, then we should start to consider an S corporation election and potential LLC filing. Once we're over $100,000 of profit, that's where the S corporation becomes that much more beneficial. For those who have passive income, it usually makes sense to stick with the standard LLC. The right business structure at the right time can be incredibly valuable for protection and tax optimization. But the key is making the decision based off of your specific situation and your timing, not generic advice from people who profit from selling you structures you do not need. Focus on building a profitable business first. As your business grows and your needs change, you can always upgrade your structure. If this helped uncover things that you didn't know about entity filings, hit that subscribe button because I'm constantly uncovering surprising truths about money that challenge everything that most people believe. I'll see you in the next video where we'll uncover more financial mysteries together.